Are you content with a 25% gain on your investment when the rest of the market is soaring at 38%? It's hardly the victory lap. You see, rational investors aren't just chasing gains. They're weighing their victories against the might-have-beens, the next best alternatives that eludes their portfolio. And savvy investors are on a quest not just for better returns, but for smarter returns, equal reward for less risk. But in the crypto wilderness, where meme coins and shiny new projects can blindside even the most astute investor, how do you pinpoint the investment that sets the bar, that calibrates your financial compass? Well, you turn to the data. And in today's show, you will learn the bedrock reasons why Ethereum is the best benchmark against which all your alternative crypto investments should be gauged. And no, we're not talking about dogma here. We're looking at the technology stack, the network strength, monetary strategy, and of course, price action. So whether you're riding the waves with Shiba Inu or sitting on cash waiting for the perfect moment to jump into the market, you'll want to grasp the pivotal role Ethereum should play in your investment decision. I've got Cody, Bentley, JJ, and Ray joining me right now to unravel and take apart ETH as we talk about why it needs to be the financial baseline. Let's get started. Okay, Cody, I'm excited to bring you back here. You're always the one on any of the beta plays to go in and unpack the technology as well as the network strength. I imagine many of the listeners already think they know Ethereum. That's fantastic, but we still need to set it up as the baseline. So tell us, where do you want to start talking about the technology stack?
Yeah, I think we need to be cognizant of how much a revolution Ethereum is. So the white paper came out in 2013, and Ethereum was launched in 2015, if I'm not mistaken. And that's almost like ancient history for crypto. Like I was not into crypto back then, so I can only imagine how much of a shock it came to people that were only trading or were aware of Bitcoin and its endless clones. There hadn't been
Absolutely.
that much.
Yeah, especially there hadn't been like computer and having been a primary contributor at one of the largest Bitcoin magazines, right? So this comes as a bit of a shock to many people.
Yeah, but yeah, so Bitcoin obviously was a revolution in of itself, but it didn't allow for programmability. Like what you can do on Bitcoin is quite limited. You can only send Bitcoin. Most people just end up holding it. But then Ethereum came out, and the biggest innovation probably was the fact that you could have these so-called smart contracts, which is basically you write the program that runs on the blockchain. For that to happen, you need two things. Basically, you need a kind of like virtual machine. It's called the EVM or Ethereum virtual machine, which is basically just like a computer that is quote unquote running on Ethereum at all times, and people can write code that will be executed by that EVM. So that's how all protocols are created. That's how you also can create a contract by yourself that maybe you do MEV or you do whatever. You can literally write whatever you want to write to it. It's almost like a fully what's the name, like Turing complete computer. The only limit is gas. This also is similar to how Bitcoin works, but not exactly. So the way you interact with Ethereum or you transact is through gas, and you pay in ETH. And there's like a base fee for every transaction that you can do that's counted in gas. So like saying storing, I think a 256-bit word or something will take you like 2,000 gas, and then the price that you pay is based on the price of gas at that point in time, and the price of gas is based on the amount of activity on the chain. So if there's more activity, the price of gas in ETH goes up, so you end up paying more. And again, you pay in ETH, and in order to use ETH in the Ethereum network for like DeFi or whatever, you need to wrap it, and that's why we also have WETH or wrapped ETH. This was basically all new, and then you also have special programming languages to code these smart contracts on Ethereum. The main one is Solidity, which is kind of inspired by JavaScript, and there's been a push to create other ones. The most successful probably is Piper, which is based on Python. There's also Joule, but Solidity is the king by miles and miles. Like there's a couple major protocols written in Viper, and there's been a lot of work going on, but Solidity is still king.
So Ethereum,
yeah.
Ethereum from a technology perspective, just to summarize where we're at here, when it comes on the scene, it becomes really the very first EVM compatible blockchain where you can actually write code, have it executable with what we now call smart contracts, which are bit of codes that you can pay, in this case, gas, to have them executed. So that I think just creates a brand new standard for the industry.
Correct. Rigs, and like they need to solve like very complicated math problems in order to be reported Bitcoin or Ethereum. And those are the miners that secure the network in proof of stake. The people that secure the network are stakers. That's users that have a certain amount of ETH or whatever the coin is, and then they stake it, they secure the network, and they get rewards. So when it came out, it was proof of work, as I mentioned, and then there was a switch to proof of stake during the merge. The merge happened this past September. September 2022, sorry, I think.
Mm-hmm.
And that was a major technological change. There has not been a single case of a network just switching from proof of work to proof of stake. Just like that.
It's pretty amazing. I mean, I think there was a lot of FUD going into that changeover, and obviously the ETH heads, if you will, were very confident it was going to play out. I think there were a lot of haters for Ethereum. I know we won't get too much into them today, but a lot of people that wanted to see it implode. Obviously, I'm not even sure they were even surprised. Perhaps they were when it actually it was able to execute, and then it's continued on. I would argue it's kind of moved on without any hiccups.
Yeah, I think a lot of people were surprised, and right now, like nobody thinks about it. But going on into it, it was like definitely something that had some people, maybe not completely scared, but definitely a bit iffy, right? But yeah, it was done without any hiccups, completely flawless execution, and Ethereum is getting on to the next phase in the plan they have for scaling, because Ethereum has had some issues in the sense that like it's kind of a victim of its own success, that it has so many people wanting to transact on it that it drives the prices, that is gas up, so it kind of prices a lot of people out of using the chain. And it also has some design, not only trade-offs, but some design choices that were made because like at the time there hadn't been that much research into virtual machines or on a blockchain, that could be changed if someone were to like relaunch Ethereum. That there's some work going into that direction, into like enabling the EVM, the Ethereum virtual machine, to be more performant. But right now, what Ethereum's plan for scaling is to become a settlement and data availability layer, and to scale execution through rollups. What does that mean? It means that Ethereum, or like people behind Ethereum, we all as users, envisage a future in which most transactions happen in other sidechains or L2s, and those L2s will be more performant when it comes to transacting, but will post the proofs. So like they will send a message basically to Ethereum mainnet saying, hey, this is the history that has happened in the rollup, and then Ethereum will sort of validate it. That's because Ethereum is the most secure network, because it has the highest market cap, barring Bitcoin, and it will also become it will also be used more for data availability, which it's kind of a buzzword that you see a lot on Twitter right now because Celestia just dropped. Which I was going to just
say, can you just define that when you say data availability for the audience?
So,
what do you mean by that?
In simple terms, it means that when you want to query the data, when you want to access the data on Ethereum, it is readily available for you. So if you have access to a node, how easy it is for you to get access to the data for all the history of Ethereum.
Okay.
That would be in simple terms what it is.
Yep. Okay. So, and I know we're going to get to Ben is going to introduce the monetary strategy a little bit later. Perhaps touch on a few of the trade-offs that you mentioned in terms of what that means for gas going up during congestion. What else, from a technology perspective, do you think the audience needs to be aware of before we start talking about network strength?
Yeah, the last point I wanted to bring up is that of standards, and I know that is kind of like a dry theme, but I think it is really important to recognize the work that has been done by the Ethereum devs to create standards for, say, the ERC20 tokens, or the ERC721, which is an NFT, and for the community to not accept, but kind of continue work on those standards and accept them and use them, right? And I think it is something that some other chains could take note of. That
has been part of the what you could call the Cambrian explosion. When I think about the ERC tokens, the first that I came across them was when they were being used for ICOs, which you can always debate the use case and utility behind them, but it's allowed them to scale a lot of people to come into the market more quickly by having those established standards to be able to use, right?
Yeah, exactly that.
Okay. All right. Well, I think that's a good rundown of technology. Again, this is a blockchain that's been around a long time. So for most market participants, they're going to have a decent idea for the technology. But let's talk a little bit more about network strength, where maybe they need a little bit of help to pull together the pieces to understand again why Ethereum remains the gold standard when you're looking and doing a beta play assessment. So walk us through what you're looking at from a network strength perspective.
Yeah, okay. So if we can take a look at the charts, producer. The first one, if I'm not. Oh, okay. I was mistaken. So this first one.
Oh yeah, we want to keep you on your toes. Yeah. All right, walk us through what we're looking at here, why it matters.
This is actually more. Well, I guess it's also related to the state of the network, but yeah, this is like the TPS for Ethereum and other L2s or rollups. TPS is the number of transactions per second, and it is kind of like it has a limit based on the technology of the network or of the chain, but it also shows you the amount of activity that is happening on the network. Like you can have a chain that is capable of doing 100 TPS, but maybe no one is using it, so it only sees 1 transaction per second on average per day. So you can see the Ethereum right now. Well, on the last day, it's the EVM chain with the highest TPS, around almost 13. The max daily TPS, it's at 22. And then comes the more interesting bits, which is the rollups that are trying to scale Ethereum. And as we can see, a lot of these rollups, even though they are supposed to be more performant and being able to handle more TPS and transaction and throughput, having more throughput and whatnot, they really don't. Maybe they are capable of doing it. Maybe they are capable of doing it in a very limited and controlled setting. Right now, the only two that have surpassed Ethereum, I think, are Arbitrum and Immutable X. At some point, Arbitrum does see TPS close to and surpassing Ethereum on a regular basis. This is a site that I look at regularly. But aside from that, there's not that many really. So even though Ethereum is using quote unquote old tech, it's still quite performant compared to some of these other chains.
Yeah. What's interesting about this is that, I mean, Ethereum is still, I mean, I guess it's supposed closer to its max daily of 22, right? It's roughly just over 50% of the way there. There's still a lot of capacity there. What is your perspective on at all about why more of the activity hasn't moved to Arbitrum, to some of the side chains or the rollups rather, where you would imagine it would be less expensive, more performant for the audience or for the user base?
I think Ben will talk about this as well, but like the main reason is because I think it's because most capital is still on Ethereum. It's where most of the opportunities are, and
Mm,
it's also the most secure chain, right? You're still taking kind of, I don't want to say a gamble, but a bit of a risk, bridging your Ethereum to other L2s. Most other L2s are not decentralized. They have in some, like, more or less centralization, but all of them are kind of centralized.
okay.
And Ethereum, on the other hand, is completely trustless and decentralized. So I guess a lot of people don't really want to take the chance.
Sure. Okay. So again, though, I guess to go back to one of the reasons, again, this whole episode, we're talking about Ethereum as the gold standard, why we use that when we talk about our beta plays. It has the most number of TPS transactions per second, and even though its max daily TPS is lower, it still has the most. If I look at the 30-day count, if we go back to this chart, it still has the most activity. And then if you're able to add in Arbitrum and some of these other rollups, it has plenty of capacity for it to meet the needs of the demand.
Yep. I mean,
Okay.
maybe not the whole all of the needs of the demand, especially during bull market, but it definitely can handle significant activity.
Okay. All right. Well, what else do you have here? Because I know we have a few more charts that you want to walk us through from a network strength point of view.
Yeah, I think we're gonna take a look at TVL and stables next, if I'm not mistaken again.
Okay.
Yeah, there we go. So we can see at the peak of the pool, TVL was $100 billion, sorry. Now it's bottoming out at 20. But I think what is more interesting here is the market cap of stablecoins. Yes, we have seen stablecoins kind of go down, but it's only not even like a 40% drop. The the peak was at 100 bill, now over 60. 55% of this is USDT, if I'm not mistaken. Um, and yeah, like, so, mostly USDC has seen some outflows, but USDT has been actually going up through this period, and you cannot you can still see some outflows on Ethereum chain, but as we have mentioned in the other episode, the market cap, total market cap for stablecoins is actually stabilizing now, and it looks like it might be increasing again. And I think you're going to see that on Ethereum um, rather soon, or sooner rather than later. And yeah, it's the chain that has the most stable coins. ERX is the second one, and it is probably where you're gonna still see most stablecoins settle on. The next chart is the TVL based in ETH terms. Again, we see a peak during the bull, and we see it coming down a bit, but only like what, by half,
Mhm.
from like 25 million ETH to 12.5 more or less right now. So yes, there has been a drop, but it hasn't been as significant. Like, the price of ETH has gone from 4,800 to like, what, 800 at the bottom, and
Mhm.
you haven't seen such a massive drop at all when you look at TVL on Ethereum protocols.
Now,
The-
if you just take the TVL here, can you just unpack some of the elements here? For example, is any of this the staked Ethereum? Is it all just sort of
no,
DeFi
no, no,
once
no.
locked in those contracts? What exactly are
Yeah,
we
no.
looking at here?
So here we didn't wanna have any, let's say, double counting. So we're only looking at TVL of ETH. So if there is some ETH sitting on Lido, and then someone is using that staked ETH in another protocol, we're not counting that. We're also
Okay.
not counting liquid staking. Like, this is just ETH sitting on MakerDAO, on Compound, on Aave, and the like being. No, sorry.
Okay.
We are counting liquid staking. We are not counting yeah, we're not double counting. Sorry for that.
That's okay. That's good clarification.
Yeah. Yeah. So I guess that's it. If we can go to the next one.
All right, more data here.
Yeah.
So
that's
what is this table list for us?
That's the top protocols by TVL on Ethereum, and we don't have to go through all of them. I just wanted to um, kind of like highlight how different they are. You have the major liquid staking protocol, Lido, and then you have MakerDAO, which is the creator of DAI, the most successful decentralized stablecoin by TVL. And you have lending in other, you have a DEX, you have more lending, some services. So it's a fairly diverse set of projects that you have, not only on the top, but also in general. Like, still Ethereum is where you see the highest protocols by TVL and a lot of the, let's say, innovation happening.
Yeah,
Which I think.
I want to ask you a question about that. Get your perspective here. How much of that do you think is because it's first mover advantage, the first EVM blockchain, it's Ethereum, versus it continues to innovate and it's continuing to invest in its network. So it really is, as you said, it's decentralized, it's highly secure, it's a good place for new developers to deploy that capital. Versus a newer chain that may have, let's say, higher TPS or some other kind of nice capabilities, but it doesn't have the history.
I think being, the first mover advantage definitely plays a role. I don't know if it's a great place for like new developers to kind of try out like new protocols. I think you're going to see more of that move to L2s because launching a protocol on Ethereum is hard. I mean, not hard, sorry, it's expensive. It's expensive as hell. But you also get more TVL, most likely, if your protocol makes, like, if it's any successful.
Okay.
You're going to see more. Yeah, you're going to see. Sorry, what's that?
And I was just going to ask, I mean, that's kind of the reason that you're bringing these, that these protocols are coming here. I would argue then this is also one of the reasons that we continue to view this as the gold standard, right? Because it's getting the lion's share of the capital. It has the first mover advantage, even from a market share from where developers are deploying. Is that how you see it? Is that one of the reasons that we argue the gold standard? Okay.
Yeah, and even if you launch your protocol on L2, if it's not like intrinsically like it's not a your fit to bond you like, because still that's most the TVL and the back.
Right. And Cody, I just lost you a little bit there. Okay, but I think then, to your point, that's where the TVL is, and it continues to be there. I know you have a few more things here. I want to make sure, because we got a lot of other stuff we're going to be reviewing here. Walk us through what you have here for active Ethereum addresses and verified contracts. And again, explain to us why you see this as confirming why it continues to be the gold standard.
Yeah, I think it's just like interesting to note that like the total addresses, yes, have gone down since the peak of the bull, but like they're still very much above numbers in 2018, 2019, 2020. And they have gone down by what this is around like 370, 400,000 active addresses a day. The peak was between 500 and 750 at the absolute top peak, but more like stabilized around 500. So like you haven't seen that many people leaving Ethereum really, which I think is quite interesting to note.
Yeah, absolutely. And we have one more here, the verified contract chart. I think it has a similar, if I'm not mistaken. Yeah, I mean, it's
even, it paints even a better picture. You see verified contracts on chain even going up during the bear. From up like 2021, you saw it like 250, 300 a day to over 500 now on a regular basis. So again, it just shows you how healthy the network is.
Right. Okay, so and it looks like maybe we have one more thing here. I know we've talked a little bit about stables. We've talked a little bit about how the sort of the protocols that are already deployed on it really sort of reaffirm that's where the market is going. Anything from this perspective, from a stable coin point of view, and what, again, I guess reinforcing that view of it being
Yeah,
the gold standard.
I guess it's interesting to note that like it is also very diverse when it comes to stablecoins. It not only has the most stablecoins by market cap compared to any other chain, it also has basically all the top stablecoins represented there. And in most cases, it's where most of the market cap of that stablecoin sits. So both USDT, USDC, BUSD when it was something, and DAI and Frax, most of that sits on ETH. And it likely
Right.
will still sit on ETH in the future.
Okay. All right. Well, that's a ton of information. I think all of it pointing in kind of the direction that we were making. Is there anything else you think from a network strength or technology perspective that you'd want to add before we start talking about the monetary strategy?
I think the last one would be how much. No, yeah, I think I'm here.
Okay.
So how much it costs to post data to Ethereum? So to store a kilobyte of data to Ethereum right now would cost around $40, and that is a bit of a steep price, especially if you compare it to other chains. So I think that is kind of like the main pain point for Ethereum. It's how expensive it is, and why it's likely that a lot of its activity will migrate to rollups in the future.
Okay. Fair enough. And I would say that's actually a very good point for the audience to know. If you're new here, or perhaps you haven't seen all of the episodes, we've done, I believe, at least 6 beta plays now where we've taken a protocol and using Ethereum as sort of the baseline, we do that comparison and make a determination on which is a better investment at that point in time. Obviously, looking to continue to update that analysis and thinking as new facts are available or as the market continues to shift. So with that, there are times when we look at other protocols. The latest one was Solana, and we were able to show some of the technology benefits that new chain, which doesn't have the technical debt, is able to offer the market and can at times offer a comparison point and perhaps even some advantages to Ethereum. So we're not here to tell you everything is perfect on Ethereum. There's challenges that they're going to continue to work on. And today we're not going to be going through all the EIPs to talk about all the proposals that would bring additional capabilities and TPS, but where we are focused on sort of, again, why we continue to use it as our baseline. So Cody, I think that's a good overview of the history of the technology and just the case for why it sits there with the majority of the capital when we look at L1s. Ben, let's start talking about the monetary strategy, because I think this is an area that you've posted some articles recently on Espresso talking about your M1, M2, M3 view of the market. And you've talked a lot about the usage of tokens and how that sort of fits into the value of the network and the value of the actual underlying token. So walk us through what you're seeing from a monetary strategy and why you think Ethereum continues to be the gold standard for the market.
Absolutely. And when it comes to Ethereum, we look at it essentially as the gold standard. So I really want to discuss, what's going on with its token today, how diverse its usage is, what its supply in terms of ETH looks like across its ecosystem, because that acts as a benchmark for us to compare all these other chains to. It helps us evaluate if something is essentially catching up to it, which would imply that it is a good beta play, or if it's not even close and it just doesn't have that great usage across the spectrum, which would imply good accrual of value to that token. But before I get to that, just 2 things real quick. When I look at a token, I try to really look at why it's being used. You look at the US dollar, for instance, it's not just used to go ahead and pay your neighbor for borrowing some item or paying for some item or going to the store to pay for some device. It has a lot of usage outside of just payment specifically. We go ahead and use it to purchase debt from the US government, for instance, to lock that up for a specific amount of time period. And in return, those dollars have value in terms of the rate at which that debt is being charged, so 5% right now. And that goes across the spectrum, right? Dollars have this wide use case, which varies in terms of liquidity, where on the one hand, you have dollars in your pocket, right? You can essentially get rid of that dollar very quickly, right? You don't have to wait for any time period to lapse. You can just go ahead, go to the store, pay it, and it's unloaded, right? But if you go ahead and lock it up in a 30-year treasury, you have to now wait 30 years, or you have to go to a secondary market. And that sort of liquidity preference kind of defines, in my mind, various forms of usage for a token. And so if you have good diversity across that spectrum, that is a really good trait to see when it comes to a token. Now, go ahead, Mark, if you want to jump in.
Yeah, no, that's an interesting perspective. And having just read a couple of your pieces, you put in really good description of why that matters. And so we'll link in the description of the video to those articles, because I think anybody who's going to hear you speak now is going to want to read more. And there's definitely some great information there. I think intuitively, a lot of people understand what you mean. I think what's less intuitive is the impact to price. So I think that's where you're going next. And I'm interested to hear what you have to say there.
Yeah, in those papers, that's a work in progress, and I really try to draw this distinction in usage directly to a change in price. And for Ethereum, I did it over the course of the past several years, and so you can see the change in usage of the token, as well as the change in price that results into it. Now, when it comes to Ethereum, it's important just from a historical perspective to realize there were a couple of changes in terms of its monetary policy and its token supply that took place that is really having an impact moving forward. And that's why, in my mind, this becomes this benchmark way of essentially managing a token supply that I think a lot of projects should really look at. In 2021, we had EIP 1559, and this really impacted, what happens to the payments to the network. Well, some of this ETH gets burned, and that has this reduction in the token supply over time as usage starts to climb. Now, I will explain the impact in just a moment. It's just the second part in terms of historical precedent was when we went ahead and did the merge in September of 2022, and it also had a change in terms of the amount of emissions or new supply of the token into the ecosystem, right? These two moments changed really the direction in which Ethereum supply was moving in. And if we bring up the first chart that I have for ETH supply, you can kind of see that supply was increasing for several years. It went ahead and peaked when in September of in 2022, we had that change in policy. You can also see the word burn right there, and you can kind of see that the supply went ahead, the slope of that line kind of decreased, and moving forward, that line implies that the supply is going to drop moving forward. And that's really important because when we think of Ethereum and we think of what happened last cycle, when the activity around the network was spiking, a lot of people sought alternative layers, layer ones. They sought Avalanche, they thought Binance, Solana, because it was cheaper. Ethereum was getting very, very expensive. It was cost prohibitive for lots of people, and they went ahead and sought out new chains. What happens is now you have less demand sitting on the network long term, and Ethereum, kind of adopting this new monetary policy, if you will, is almost front running its change in technology to where these layer twos that are building on Ethereum, when the gas costs start to rise again, and these users find it prohibitive to go ahead and conduct transactions, they're going to seek alternatives. And if they can go ahead and find a layer two that still interacts with liquidity on Ethereum's mainnet, that's a game changer. And now transaction fees drop. Now, take a step back for a moment. If you're going to go ahead and say run a railroad system and you're moving all these different products from point A to point B, And all of a sudden, the cost to transport these commodity items just drops by like 90%, right? You as a railroad company, your revenues just got hit hard. You're not really able to go ahead and sustain everything that you were sustaining beforehand. And so that's kind of like the change in transaction costs that a lot of these networks who make these really robust upgrades to where the throughput just jumps, the cost to go ahead and do these transactions drops significantly. These technology changes are deflationary for if you want to look at a network like an economy, it's very deflationary. And when it comes to understanding the cost of a token, you just drop your demand significantly. So now you no longer need as much of that currency to go ahead and transact on the network. You kind of have a supply demand mismatch. And so what Ethereum's doing here is they're trying to reduce their supply in a way, whether that was intentional or not, it is what's happening. And so as that cost to transact starts to decline, the supply is declining already ahead of time. So now when demand activity starts to spike, the amount of the burn rate starts to increase, and the emissions is already lower. Ethereum's essentially front running what this deflationary advancement for its network could do to the price of the token, which I think we talk about the gold standard here. A lot of these networks don't really think like that ahead of time. Like they're all pushing for very low cost of transactions for a network, but what's your impact to the price of your token? That's really important, and it's a major oversight that's taking place. I think I don't know if it was like a year ago or so, but Arweave made a big kind of mishap with that, and they're paying the price for it right now with their token. And I'm sure we can go on and on about other projects that kind of have fallen victim to, but that's just one really important point when we talk about a benchmark. Really a project just taking into consideration these technological changes, the changes of their users' behavior over time, and as well as what's going to happen to the price of their token, and how should supply maybe change to better match demand. And I think Ethereum is the closest, and that's why I like to view it as the benchmark for a lot of things with monetary policy.
There's a lot packed into what you just shared, and I think for some listeners, I imagine it's a little bit complex. There's a lot of concepts to come together, but that's a little bit about what we're trying to unpack on all these episodes. Give us something that can be a sort of bright light with all this information, which in this case is trying to match the capability of the network as it continues to improve. And Cody talked a little bit about that, even summarizing some of the improvements they've already done since they initially launched, including moving from proof of work to proof of stake, increasing TPS, moving on to the rollups. As you start to have those capabilities come online, you then have to ask yourself how to manage the monetary policy so that the value of the token is not plummeting, right, over time as you're able to do more with the network.
Absolutely. What happens to, say, the U.S. economy if its population just doubled tomorrow relative to how many dollars are in supply? Right? These sort of conversations almost are non-existent in crypto. But if you were just to take our current example of monetary policy and everything we've learned over the past century, or even less than a century with fiat currencies, like this is a little bit more understandable. Okay, population maybe cuts in half. What happens? Or amount of businesses double and explode. Like these things are more intuitive when we think of them in dollars. But as soon as we get into crypto, we almost completely forget those things. But I will say there's a lot of people thinking about these things at a very nuanced level, and they're doing a lot of good work on that front. And I expect that to really grow in the coming year. But for now, maybe we just jump right into okay, we talked about ETH as being this benchmark, this gold standard. What is it that makes it unique? If I can go ahead and start jumping into that.
Yeah. I was going to say let's move on to that, to some of these other charts, because I think they paint another picture again of reinforcing our view of why we use this as a benchmark.
Yeah. And if the producer can go back, I don't know if we dropped that table of ETH token supply in time, but it really just kind of goes into the current supply.
No, producer, there's a little table. There we go.
No, that's not. That's not it either. Not to worry, I can quickly explain it.
Okay.
You can go ahead and go to ETH's main use case, which is the staked Ethereum as a percentage of circulating supply. I think it was the second chart you had up there. In the interim, I'll go ahead and break down ETH token supply. So it's currently about 120.3 million. A year ago, it was 120.5 million. Since then, the supply change has dropped 0.2%. In 1 year, it's expected, based on the current validator set, to be about 119 million, which would indicate and be more than a 1% drop in its total circulating supply. So in terms of what the amount of ETH in circulation is going to look like, we can see that moving forward into 2024, supply will be dropping. And as a bull market resumes, I would expect that number to be even more. So good to keep in mind. Now, as far as that circulating supply, what is it doing? Where is it at? This is the primary use case on this chart, which is using ETH to be staking for the network for security purposes and earning yield. There's primarily two ways you can go ahead and stake your ETH. You can do it in a native instant with the beacon chain, and then you can do it in a way where you have a liquid staking derivative when you go ahead and stake to the beacon chain. So these two different ways of staking are shown in this chart. The light blue is the amount that is staked without a liquid staking derivative, while the purple is the liquid staking variety. It's important to note what took place around May of 2023 here, but before we go on to the table, you can see the percentage of ETH is over 20%. It's about 23.3%, I believe, of all ETH is being staked, which is a lot less than a lot of other layer ones. So keep that in mind here.
Yeah, I was going to add, because I think we've looked at some that have somewhere upwards of 60%, if I'm not mistaken.
When there's not much diversity of the usage of the token, you will, and as well as various DeFi protocols that exist on the layer one, you're going to find that stat much higher. And a lot of that reason has to do with credit markets, which is what we'll get into later. But for now, you can see this number. I have to imagine it's going to start plateauing here shortly. It kind of was before that May point in time, and then I'll explain on the table why that changed, which was the reason for Shanghai. Shanghai really changed this. It was an upgrade to Ethereum that allowed ETH that was staked to finally be unstaked. It was like this moment of relief for the market where there's no question that you're not going to be able to unstake, which ever since they opened up staking, it was always kind of a running joke that you're never going to be able to get your ETH back again. Good luck. It's locked forever. But here we are, Shanghai happens, and now you can go ahead and unlock. And then what that did was essentially create a lot of confidence in the market towards Ethereum that you can go ahead and stake. And not only that, you don't necessarily need that liquid staking derivative anymore. You don't need that liquid exposure to what your ETH is essentially being staked for. Now you can go ahead and unstake it if you want to go ahead and liquidate that ETH into cash or some other asset. So you can see here, 90 days ago, really focused in on the non-liquid staking percentage was around 11%. It's since today risen up to 14%. Liquid stake went from about 8%, and now it's just over 9%. So that's one of the more interesting trends of late. If you go to the next chart, we see the total supply of ETH, and I know that's a big gray area, and so that kind of is supply that that's very low forms of usage of the token. This is broken into M0, M1, M2.
And I was going to say, Ben, for the audience here, I think they may be familiar with hearing M0, 1, and 2 for for traditional markets. Explain what you mean here as it's being applied to Ethereum.
Sure. And the use of M0, 1, 2, even 3 in terms of base money supply has to do with the liquidity of dollars, where M0 is essentially the most liquid form of dollars. And then as you go to 1 and 2 and 3, that sort of changes, where the difference between, let's say, M3 and M2 is going to be this lengthy time deposit. I mentioned this 30-year treasury, for instance, like that's a time deposit. I think it's really 2 years is the mark on that definition. But the point being, M0 is essentially the lowest form of usage and it's the most liquid form of a token. M1 is ETH sitting in a smart contract. You can think of these as like swap contracts within a decentralized exchange like Uniswap. These tokens are liquid. People can essentially be trading for them, but they're sitting in a smart contract, so they're sort of less liquid, but they still have a very high liquidity in general. M2, not only are they in a smart contract, but they are locked up and there needs to be an action to go ahead and unlock that, which you can think of this as like collateral for a loan, staking to the Ethereum network without the liquid staking derivative component. Right? These are really good inflationary sinks. And that's sort of what we see with this chart here is, we mentioned earlier, staking directly to Ethereum without that liquid staking derivative had a major uptick since Shanghai. And that's that purple area right here. And that's really responsible for this big uptick in that form of usage. And this chart I break down in a very granular sense in those papers we mentioned and how those changes really influence price throughout the last few years. And I think the main takeaway on this chart is if you look at July until we're recording this in November of 2023, like that purple area is getting massive. And the way we could think of that is this creates this responsiveness to price that can be very dramatic. Right? A little small uptick in demand can create outsized movements in terms of price. And so this is like if you want to use the analogy of powder keg, you're looking at it right here. Like that's the current environment we're sitting in for ETH. But yeah, go ahead.
Yeah, I just want to break in here. So I think when I look at this chart, and again, going back to sort of our question, why is Ethereum the gold standard? You see the higher forms of usage increasing over time, right? And which is exactly, I think, what we'd be comparing Ethereum against other protocols or other networks is to ask, are they doing that beyond that or not? Because this is the exact trend that we're expecting to see, or we would like to see for a very strong monetary strategy. Is that a fair statement?
It is fair. Now, I do want to draw some criticisms, though, at the same time. Like, Ethereum, while it's the gold standard, it's not perfect. We mentioned a major form of usage for that M1 and M2 category is staking. Like the next chart, we actually draw in what the supply is. So this is the categorization of M2 that is not staked. And just look at that y-axis here. Like the amount we're talking about is 2.5 million. And we were talking about 110 million, 120 million total supply. So this is a very small category of how ETH is being used throughout the network. And these are just the top 10, but this makes up, almost 90% of the category we're trying to look into here. And if you probably can't see this if you're watching this on YouTube right now, but you can see there's Aave V2 and Aave V3, and there's also Compound and Compound V3. I have to imagine, based upon looking at sort of how stale some of these lines are in the kind of area that they are composed of, I have to imagine a lot of ETH on some of these lending protocols are just lost keys. I hate to say it, But I'll make mention of why that's the case here momentarily. But just before I do, I would like to bring up the next table, which kind of shows this chart in a different form, in a table form. And I kind of want to just draw attention to Yearn down there, which kind of popped up out of nowhere here with the amount of ETH sitting on its protocol of almost 60,000. Like, that's a very interesting use case for ETH in the way that, you know, it operates. But you still got Aave V2 sitting very high up on that list in Compound. So as far as that looks like we're going to hit on that in two charts. But for this, just note that the amount of ETH being locked on these various protocols, we're not getting much change. You know, it was 2.5 million 90 days ago, and it's 2.4 million today. So again, I said not everything is rosy here. You want to see these numbers be climbing right now. And if anything, everybody's just moving into staking is the predominant move on the network.
Yeah, and to be clear, when I guess with my statement, I certainly wasn't suggesting perfection with the Ethereum network. I think, as Cody pointed out, there's still work to be done in terms of development on the technology side. We'd like to see network strength continue to grow. But again, if we're looking at comparative points from an investment standpoint, in many ways, and as we continue to go through on this episode, Ethereum continues to be the standout. So, but obviously, to your point, a lot of room for continued growth. And it's possible as we continue to evaluate other protocols, we see some that start to move in front of it in terms of speed and adoption.
Yeah, and that almost brings up this point that it's like it's so easy to point out so many of the negativities when it comes to a token design or how a supply is operating, the distribution, the allocation, the emission rate. You know, how staking is being used on a protocol, nudge, nudge, Arbitrum. But it's comes down to, like, what is good? And when somebody asks me, like, okay, can you show me a good example? And it's like, man, you know, I really don't have a good example. All I can say is what's not working. And that makes it even harder. And then I feel like such a cynic at the same time and a pessimist, but it's, you know, at least we can see what is better, I should say, than everything. And in ETH right now, it's doing a lot of good things. It's got a ton of improvement ahead of it, and it's still extremely young. I mean, maybe we'll just get to the point here on the credit markets table, and just kind of jump into. Let's see, I think it's two tables from that one. Yeah. Thank you, producer. You can look at those percentages. So, you know, right now, what you're getting for staking is just over 3%. And so that's a decent yield for ETH. A lot of ETH is getting flocked into that use case. As far as using ETH to provide liquidity on a swap protocol, I like to look at ETH versus a derivative swap of it. So this would be ETH to like staked ETH. That way you don't have that impermanent loss eating to your position. So 2.28%, that's pretty good. Because it's very close to what the yield is for staking. ETH to a stable coin at 6%, I think that's fair because we are entering into a bull market. You would have a bit of impermanent loss coming into your position if you're holding a stable coin. So the fact that that rate's higher, that's logical. But then you look at ETH lending right here at 0.6%, right? This is kind of a composite figure of the top protocols by TVL. We don't look at V3 Uniswap because looking at that yield is not fair because people in that pool are not earning that. It's only a very small demographic that's earning it. So we try to make it a good representation, but you look at lending and you got 0.61%. And if you don't mind, producer, going back 2 tables to the top 10 protocols, that's fine right there. Like, look at how much Aave, ETH is sitting on Aave and Compound. It should not be that high, right? We just talked about kind of logic in the credit markets. You got 0.6% in terms of APY on the ETH you're lending out, and you got over 3% on staked. Why is that ETH sitting there on these lending protocols? That makes no sense to me. So that's why I kind of think there's a lot of stale ETH in the market right now. and that'll probably get uncovered here moving forward when you don't see that ETH migrate off the platform. But yeah, so if I were to sum it up, it's the gold standard for sure. It's taking into consideration what's going to happen with its users over time, trying to adjust its supply relative to that, as well as to the cost of transactions. It's got good use cases. It's the best of the bunch right now, but it's not perfect, right? We still see some non-logical behavior taking place on Ethereum, but this is our benchmark, right? This is the best I've seen, and I like to gauge everything according to this. So I'm glad we did this episode. ETH to itself is ETH beta to itself. I gotta imagine it is.
Yeah, there you go. All right. Well, there's so much data that you just unpacked, Ben. But I think for the listener who's asking the question, as they continue to watch new episodes of Beta Play, they can refer back to this to really get a grounding on how we think about the analysis that needs to be performed. It's not just about narratives. It's really a question of the parts you talked about, the monetary strategy, the supply that's outstanding, how much is going to be coming into the market, how the token is actually going to be used on the network, and then what you're starting to see around credit markets. And for all you listeners out there, if you made it this far, I think congratulations, because we're giving you a lot of information, hopefully a lot of good information. Let us know in the comments if there's things that you're confused about, you have questions, or perhaps there's other points and metrics that you think we should be including here, either on the technology side, on the network strength side, or on the monetary strategy side, something that's missing. Let us know in the comments. I'd be very interested to hear that. In a few minutes, we're going to get Ray up here to talk a little bit more about, is now a good time to be buying Ethereum, obviously, because we've been talking about it as a gold standard. But before we do that, JJ, we're going to bring him up here. We're going to answer kind of an interesting question, because when we talk about the gold standard, we laid out a case that actually almost looks price agnostic, right? And now the question is, does Ethereum have the gold standard even from a price point of view? And JJ, I want you to walk us through what you see and why you think it's, again, on a price level perspective, it still remains the gold standard that we're looking at.
Yeah, thank you guys. That was very good and very enlightening. And it basically pairs with what I see, right? So the way I look at it, like if you're somebody who's actively managing funds or just investing in crypto, what is your upside for doing that, right? So you could go out and find any altcoin when it's ripping, and maybe it'll 2x, but what good is that if Ethereum 5x's or BTC goes up more than that? Then you're just taking excess risk, getting into something that's possibly illiquid for diminishing returns, right? So if you're going to be actively trading or deploying funds, you need to have something to measure that against. And the reason why we pick ETH is because it's Lindy. So it's outperformed Bitcoin in 2 cycles. So it has that body of work to rely on. And then when we look at like the top performers from past cycles, right? So for fun, I looked up CoinMarketCap, and you can do like historical time grabs there. And if you look at like the top 20 from January 2018, you see things like EOS, Neo, Quantum, things that basically don't exist anymore. You could do this again in 2021, and you would find the likes of Terra Luna. So there are going to be things that outperform ETH, but will they outperform ETH over time? And do you want to denominate your gains in those tokens? No, right? It's just kind of a no-brainer, because they're like a flash in a pan. You kind of get those quick gains, but are they long-lasting? Are they going to be duplicated in the next cycle? More than likely not. And the reason why ETH does is because it has such a strong fundamental case, which Ben and Cody did such a nice job of laying out there. And also it has liquidity. So we see institutional adoption. We just saw CME futures approved. So there's a lot more ways that money can enter ETH and also exit ETH. There's a door in and door out, unlike many alts where you can just kind of get in and then you better hop out before the music starts, right?
Yeah. And we just talked about Shanghai unlocking the ability to actually take your Ethereum, your staked Ethereum. So again, creating the promise, delivering on the promise, and showing that the liquidity can enter and exit.
Yeah. And most chains, right, like the things that go up the most are when they're the most speculative. And obviously when they're the most speculative, it lacks in fundamentals. And ETH is kind of the opposite of that, where you can get exposure to massive gains, like we've seen in the past 2 cycles where it does multiple X's. Maybe that doesn't happen again, or maybe it does. But you have that upside potential, because as Ben said, we're still not at max capacity. Like, what if the ETH population doubles within the next year? that's not priced in, right? So you still have all of that upside, and there's also a functioning model there. Like there's a verifiable way that this thing generates revenue and delivers that back to Ethereum holders. So that would be my number one reason for declaring it as the gold standard for beta plays. And then on top of that, you have things like the option markets, right? So everything that we've been discussing in recent episodes, how this allows for people to extract extra yield. You're holding ETH, you can sell some of your upside for tomorrow for immediate gains today and collect that premium. And that was something that's kind of been the theme of the year with ETH, and possibly a reason for its underperformance is there's just been some large call writer who holds a bunch of ETH and then was selling calls against it. And what that was doing was suppressing the price. But interesting enough, what we saw after that mega gamma squeeze a couple of weeks ago is all of a sudden Deribit said, hey, we need to raise our margin requirements, which means if you want to sell calls against your ETH, you have to post more as collateral. So when they did that, an interesting kind of microstructure thing in the market here is that seller's been closing his positions. So this person that's been selling calls and suppressing price, basically keeping ETH capped at 2K all year long, is now no longer in the market. So I kind of get the feeling that I'll let Ray expand on this a bit more, but I see ETH as reminding all of the alts pretty soon here in the future why it's the king. And I think we'll see ETH go on one of its major tears, especially if Bitcoin get back above 37K or so this month. I think ETH is primed up for a nice run. And just as an extra bit of alpha, one way to think about possibly positioning for that is take a look at the ETH Grayscale Trust. We're still trading at about a 20% discount to NAV. I think given that we've already seen CME futures approval and what the court ruling was with that, where they basically told the SEC you can't allow a futures ETF and not allow the spot ETF, it's probably only a matter of time before there's an ETH spot ETF, which would bring this thing back to par, and you would get a nice, easy gain there. So with that, I'll pass it on to Ray.
Well, I was going to say, just to butt in here real quick, I think the case there is really simple. This has survived multiple cycles. It continues to have very strong fundamentals. You tie that to the fact that the price has had accumulation, and we continue to see capital stored on there. From that perspective, it continues to remain a really good baseline from a price perspective. And I know in many of the beta play analysis, you're being able to look at the price of the alternative token, denominate ETH, and make some kind of determination from a price point of view. So I think the case there is pretty strong. And for the listeners who are asking questions about some of the terminology that JJ just shared, I would like and subscribe, because in the coming weeks and months, he's going to be putting out his own class on options trading, where he's going to break down all of these concepts and really give you a behind the scenes look at how someone actually uses them to be a successful trader. And we also just recorded an episode in which we were talking about a regime change. If you're interested in, again, hearing about options market, you're going to want to listen to that, because we're talking about the implications of that change. So very good, JJ. Thank you, Ray. Last but certainly not least, we want to bring you up, and we're talking about Ethereum as the gold standard. Now, if you're someone who's sitting on the sideline asking, okay, should I be buying today? We've seen some crazy price action. I guess the question is for you, how do you think they should think through that question? Is now a good time to buy? Should they be on the fence? Answer that question.
Well, the talk of the town the last 2 weeks has been heavily focused on whether or not the ETH BTC pair has bottomed and what that might mean for the market. Can you hear me?
I can. Yeah, no, that definitely is a good question to ask. What are you looking at for that?
Perfect. So I think prior to digging into that and the potential trade in isolation, it's worth pointing out that the total crypto market aggregate open interest, so that's the first chart, it's recently hit a year-to-date high. And a different chart, it's from Coin Analyze, shows all coins in the crypto market open interest. It's black with kind of a green background on it.
Let's wait for the producer to find the one we need. Is this the one that was recently?
No, not that one.
Not price
all
strength.
coins open interest. It's the coinanalyze.net chart. Let me see if I can find the actual name of it in our file. that would be. Oh, it's not there. That's okay. We will upload it later for you guys to see.
We'll blame the producers on that one, but we'll come back to it. All right. Yeah. So walk us through what the information tells us.
Okay, so now I got to find my doc myself. So yeah, the aggregate open interest has hit a. There it is. Yeah, there you go.
There we go. All right, coming through in a pinch.
Yeah, so it's hit a year-to-date high. Total crypto market capitalization. So that's hit a 14-month high at 1.32 trillion. And as we speak, a number of altcoins are up at least 100%. A cool chart that we have from JLabs shows Ethereum strength. And hold on, I gotta go look at that myself.
Price strength.
Yeah, the price strength chart for Ethereum. It's I believe it's a compilation of multiple moving averages, and this indicator has turned green, which shows price strength for Ethereum and its USD pair. And we see that reflected in Ethereum's price action currently also. So Bitcoin is up, total market cap is up, the altcoin market cap is up, but did the ETH BTC pair bottom? And should we expect Bitcoin dominance to revert as altcoin dominance increases? I think some of the more immediate positives for Ethereum also, if we're looking at it as like a beta play asset, is its weekly revenue. That's the income from network transaction fees. It rose from 30 million. It rose above 30 million for 2 weeks in a row, and that's up from a yearly low at 12 million. And then data from Into the Block also shows that the network has settled $250 billion in asset transfers over the last week. And this was the highest amount seen since August of this year, when the figure was at 105 billion. I think another kind of thing that would get people's eyebrows raised or kind of tickle your ears is Ethereum's ultrasound money dashboard, which shows ETH supply, whether it's emissions, is it deflationary, so on and so forth. So supposedly increased network activity leads to more ETH being burned than added to its supply. And this turns the asset deflationary. And some investors interpret this as being bullish for price. And that metric has recently turned deflationary if you go look at the ultrasound money dashboard. In addition to this, so it's kind of the last thing here, is that the amount of staked ETH also continues to soar. Currently, it's at 32.37 million. And this figure was around, I think, like 19 million when the merge first occurred. So at face value, beyond the price action of ETH and its USD pair, there's a lot of kind of trends that had been stagnant or kind of negative, which have in a way turned positive. And that's noteworthy, right? Like it's at least showing perhaps a change in sentiment or a regime shift, like we talked about in the previous episode. Now, if there's time, I'd like to actually dig into the price analysis and the pair.
No, I think so. Just to summarize there, I'm hearing there's a lot of confluence suggesting momentum, good, as you said, good sentiment towards Ethereum. And I think, if I take the technology and I take the monetary strategy and I even look at the case for, why we would look at it as the gold standard, all of that seems to suggest it is a good investment. I think that then my next question is, okay, how do people think today? We're in Q4 of 2023. How do they think about how to position now? Potentially, are we going to see a fake out of something in the next three months, perhaps? Because the market, as you said, it seems like we're moving really fast. Or is this a good time to start doing a DCA in? Because maybe we've hit escape velocity and we're not looking back.
That's a good question. So prior to today's Bitcoin price breakout, which is kind of getting into the squeeze territory that a lot of us have been looking at, prior to that, I had kind of a cautious take on Ethereum. It's something that personally, as someone who trades it, I hadn't really been that interested in it recently beyond just occasional, okay, I had a profitable trade, so I'll put a little bit of it in ETH just to be long on it. But that perspective for me has started to change. When you look at the altcoin dominance chart, so when you like look at the market cap of all altcoins versus the market cap of Bitcoin, we can see that altcoin dominance has risen over the past 3 weeks as Bitcoin dominance began to pull back from its high at 53.44%. So that's a metric that I would keep an eye on to see if altcoin dominance continues to rise. Does ETH price tack along with that and continue to rise? Now with Bitcoin breaking out today, what usually will happen is Bitcoin dominance will begin to absorb more of the money that's in the crypto market and kind of revert back toward that high. And we see altcoin dominance either consolidate or begin to fall. And that's reflected in the ETH BTC pair today, right? Which is pulling back. If you look at the ETH BTC market structure on the weekly time frame, the price is trading at a key pivot point or a key support level, which is aligned with the 61.8 Fibonacci retracement level. That's at 0.052. And the volume profile also shows the next level of support below that level at 0.038. So in the event of further downside, that's where I would be looking for price to fall. If it didn't bounce at the 61.8, which some traders this week already called a double bottom at the current 61.8 fib for the ETH BTC pair. So if this was the case and price can bounce back from this level and then snap back to range, let's say in the 0.07 zone, that's what I would hope for. But ETH and its USD pair, I think that its upside is capped. And it's following pure technical analysis in terms of like support resistant flips and Fibonacci retracement levels. So it's easy to also see how if Bitcoin was losing momentum, which I felt it was up until today, how that would impact ETH in a different way than other like speculative low cap altcoins. So ETH price and its USD pair currently still trades below 2,000, right? It's meeting resistance at 1,900, and that's aligned with the 61.8 fib. So generally that level tends to present itself as resistance on a move that's going from downside to upside, and then it serves as support when price breaks down. We look for a bounce at the 61.8. And if it holds, then sometimes it's a reopen that trade and go long opportunity, especially if it's aligned with like important daily moving average, like the 20-day moving average. But in the short term, I do believe that ETH is capped at 1,900 and capped at 2,000. And with the options repositioning happening, we could see that upside. If there's a breakout, we could see that upside up to like 2,300 to 2,500 in the medium term. But that's my basic view on Ethereum right now. I would keep an eye on altcoin dominance versus Bitcoin dominance. I think the action in the USD pair, unless you're just a swing trader, I think the action in the ETH USD pair is less important than the kind of SR flip that we're looking for in the ETH BTC pair.
Okay. A lot of information packed in there. I think for those who are thinking about buying in right now, maybe more from an investor standpoint and less as a trader, I think you can go back and re-listen to what Ray just shared, because there's a lot of different ways you can unpack that information and think to yourself, is this the time to buy? Should I be DCAing? Maybe this is more of a trade opportunity. As he pointed out, there's some clear resistant zones, but nothing is a given, right? We're seeing, as we're recording this, we're seeing a breakout for Bitcoin on the USD side of it. And it's possible that we're going to see a rip higher longer. For those who are listening to our episodes every week, you know that we cover this. We talk about where we think the market is going and how that should be, how that's informing the way we're looking at investments and trading. And so hopefully the same thing for you. And with that, we're going to wrap up this episode. This has been a long one, but I think it was needed. We needed to unpack our view on why we're using Ethereum as the baseline or the really what we're using, as I said, the baseline for our beta play. We've got 6 of those, and we've got many more that are going to come because we think it's important for all the investors out there to be asking themselves, where am I allocating capital, and am I getting the best alternative? And right now, it remains that Ethereum is definitely the baseline. I want to thank Ray, JJ, Ben, and Cody for sticking with us and sharing their thoughts. For those out there and you've got questions, I'm curious, are you using Ethereum as your baseline? Are you using a different token? And if so, why? We'd like to hear that. And if you've got questions about the analysis, let us know in the comments. We'll do our best to respond to that and see how we can incorporate it into the next set of episodes. And with that, I am going to wrap it up. This is Marconi White signing off.